So while people are still trickling in here, we'll go ahead and get started. Again, thank you for joining us this morning. We are going to be discussing the state of the M&A market post-election. I know we still have some things to figure out and decide as a country, but looking forward to this discussion, and we hope you are too. Before we do begin, I have a few housekeeping matters to get through. For those who do not know who I am, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We're a lower middle market focused M&A organization. We cater to transactional professionals, primarily private equity firms, investment bankers, lenders, independent sponsors, family office. We are a membership-based organization with chapters in Los Angeles, Chicago, and New York. Given COVID, we have shifted to virtual, so everything is online for now. In addition to those chapters where we do monthly seminars, we also do deal sourcing events around the country. Again, everything is online, but we pair up private equity firms and investment bankers for one-on-one meetings throughout the day. If you're interested in learning a little bit more about Opus Connect, who we are, how we can help, please feel free to reach out to my colleague, Jacob Zeffrin. His contact information is below. Our panel will be taking live Q&A today. So as questions pop into your mind, go ahead and jot them down. There's a bubble at the bottom of your screen labeled Q&A. Please do not use the chat function. Utilize that Q&A bubble, and our moderator, Chase, will monitor those, and we'll try to get to as many as we can. These events, of course, would not be possible without the support of our sponsors. So we definitely want to give each of them a quick shout out and allow them just a few seconds to introduce themselves and their firm. I don't believe Steve Finder is in here from Focus Search, but they're an executive search firm. They've been a partner of ours for most of 2020. If you want to learn a little bit more about them, contact information is below. You can look them up online as well. NFP, of course, longtime insurance sponsor in New York. Duncan, I see you in here. Go ahead and introduce yourself and your firm, please.
Great. Thank you, Lena, and the rest of the team at Opus for hosting the event a couple days ago and today's event. I think it'll be interesting to hear people's thoughts. So Duncan Cummings here with NFP. NFP is a insurance broker and consultant. We have been sponsoring and involved with Opus for a while, and a large focus of ours is on supporting our private equity clients and their portfolios with all insurance related matters, everything from due diligence to cross portfolio work and transactional insurance policies like rep and warranty. We happy to answer any questions. Happy to kind of discuss any insurance related issues. But hope you enjoy the event.
Thank you, Duncan. I don't believe Doug is in here, but I do see you, Andrew. If you want to go ahead and introduce yourself and your firm, that'd be great.
Absolutely. And thanks for having us. Happy to be here as a sponsor. So my name is Andrew Brown, Managing Director for Financial Services Practice at TriNet. Brief background here. TriNet is a human resources outsourcing company. We've been in business for 32 years, went public in 2014, and currently have about 1,500 alternative investment firms on our platform. They rely on us for HR infrastructure and support, as well as top tier benefits for their employees. Also, we've helped many small businesses navigate through the unforeseen complexities in 2020. So we're looking forward to share a little bit more about our industry later during our little slot for the educational session. So thanks for having us.
Thank you, Andrew. Marcum, I want to give you a quick shout out. We have two gentlemen from Marcum on the panel today, so we'll wait until we introduce the panel before we dive into Marcum a bit more. And of course, Ice Miller as well. Chase Stuart of Ice Miller is going to be moderating today. If we were not doing this event virtually, we would be Ice Miller offices in New York. So a little bummed about that, but happy to have Chase here, of course. And as always, before we do get to the discussion, we have one poll question that we'd like to ask of you. I would encourage all of your participation here. This will give us a good idea of who's in the audience. Excuse me, who's in the audience. So you should see a dialogue box here pop up on your screen. Go ahead and submit your answer. We'll move through it fairly quickly, give you about 20 seconds or so, and then we'll get to the good stuff. Okay, so I'm gonna go ahead and end this here. It looks like good amount of independent sponsors. We do have a deal connect following this with independent sponsors and capital providers. So happy to see you guys tune in here for this part. 14% independent sponsor, 21% investment bankers, capital providers on the debt and equity side, and of course, our sponsors. Thank you all again. Appreciate you all participating in that. And without further ado, I'd like to introduce Chase Stuart of Ice Miller. Chase, go ahead and take it away.
Hey, thank you so much, Lena, and thanks everybody for attending today. I think we're gonna have a really good discussion. So we have a great group here today with accounting and legal advisors, along with private equity fund and a lender. So we just need an investment banker and a seller, and then I think we can get a deal done. But the goal today is to discuss the M&A market following the election, and I know following may be in air quotes right now, but I think this should still be a pretty interesting discussion. Just a quick introduction on myself and my firm. So I'm a partner in Ice Miller's business group. My practice focuses on representing private equity funds and independent sponsors and other financial buyers in lower middle market and middle market M&A transactions. For those of you who haven't come across the firm before, we're a Midwestern-based law firm with over 300 attorneys, headquartered in Indianapolis. I'm in our New York office, and so if anyone's got any questions about Ice Miller or otherwise, happy to answer any of those questions. And before we get to the discussion on the panel today, I do want to just introduce our panelists. And once again, thanks to Opus for setting this up. And thank you to our panelists for being here. So I'm going to start with Dave. Dave, can you unmute and give an introduction? Because I think you may still be on mute.
How's that? Well, there are many mezzanine groups in the United States, probably 50 or 100, whatever. So we started back in 1992. So every day some gentleman decides to retire, and oftentimes they an equity group comes in or an independent sponsor comes in, and the bank will say, well, we can't do 4 times mezz, but we can do 2.5, and then we have to find some mezzanine groups. So the mezzanine groups are they all look the same, and but it helps get a lot of these deals done.
Absolutely.
That's all I need to know.
Well, thank you. Thank you for being here. I'm going to go to Andrew next.
Thanks, Chase. It's nice to see everyone virtually. I am a tax partner in Marcum's transaction advisory group on the tax side. And I also lead Marcum's National Tax Office Services Group as well. I have been doing this for over 30 years, 32 years now. I'm a CPA and an attorney as well. So I've been doing, really concentrating on transactions for the past 20 years of my career. I'll wait for Rich. I'll let Rich introduce Marcum to you. And I really look forward to this panel today.
Thanks for being here. And let's go next to Gerry over at Kidd & Company.
Hey, everybody. Thank you, Chase. Thank you, Lena. Thanks for having me today. My name is Gerry DeBiasi. I'm a partner at Kidd & Company. We're a bit of a hybrid between an independent sponsor and a small single-family office. We're generally investing $2-ish million of our own capital and then partner with debt and equity capital providers to invest alongside of us in lower middle market opportunities. We're thesis-driven investors. We'll oftentimes spend a year or more developing a thesis, finding the right pieces of the puzzle to execute that thesis before we actually execute a transaction. Very growth oriented. We want to be able to see a way where we can accelerate the growth of a particular opportunity, whether it's new products, new channels, new geographic markets, new vertical markets, additional acquisitions, building out a sales force, whatever it might be. We're very focused investors. We, our portfolio, if you even want to call it that at any given time, is 3, 4, 5, 6 companies. So very focused model, few eggs in our basket, but we tend to nurture those eggs quite closely. So that's just a quick overview on us and myself.
That's great, Gerry. Thank you. And Richard, can you introduce yourself to the group today?
Sure. I'm Rich Izzi, and thanks everybody for joining today. I'm the partner that oversees the tri-state area transaction advisory services practice, as well as some national factors of what we do. I've been doing this for 20 some odd years, 25 years. And like many of the Opus members, prior to doing this consulting, at one point in time, I was part of a small independent sponsor group that grew into a full fund that we ran for 11 years. So we do have at our firm a unique perspective of sitting on the other side of the table, which would be your side of the table. And our firm's a top 15 in the United States. And we have a strong practice area in transactions, SEC, and certain other areas, but we're a full service firm. And happy for everybody to be here today.
That's great. And so as we begin today, I want to remind the people in attendance, feel free to ask whatever questions you want. There should be an option for you to submit them, a Q&A button at the bottom, and we'll be happy to discuss those. This is going to be an interactive discussion, and we're all responding to the changing world in real time. So the election, of course, was Tuesday. We still have some uncertainty as to exactly what's going to be happening and who's going to be controlling both the White House and the Senate going forward. And so I want to begin just with a discussion of how you're seeing the M&A markets as we get to the end of 2020 and into 2021. I could say personally, we've seen at Ice Miller a big increase in M&A activity starting in about June. The third quarter of this year was a really busy quarter. A lot of our clients were active. We also saw a lot of sellers coming to us looking to sell their businesses before the end of the calendar year. And I just want to hear how people are seeing the market. Is the last 2 months, these last 2 months of 2020 going to be just as busy? Are you hearing things about 2021? And are you anticipating anything about the election changing that? So, whoever wants to start, please feel free.
I can start if you'd like. We've had at Marcum much the same experience that you just described, Chase. We had a little bit of a lull. We were busy in January and February and actually had a number of deals closed that hadn't quite made the December 31st cutoff. And then things slowed down a little bit for obvious reasons, but only for about 2 or 3 weeks in March. And right now we've been busier than we ever have been. And there's been some shifts. There's obviously this mad dash to sell your company before the election and before some more tax uncertainty sets in, which it's a little late, for that now. But we've never been busier, and our pipeline has never been longer. And so we're certainly experiencing a wave of M&A activity that I don't know, the last 10 years have been surprising. This continues to surprise us.
Yeah, it's interesting that you mentioned that, Rich. We're seeing somewhat the same thing. We're a little bit different because we're more proactive than reactive in terms of new deal development. We continued plowing ahead through the pandemic and actually closed our most recent platform in June of this year, when I think M&A markets were generally quite slow. But we are, as you said, we are seeing some sellers on deals that we're working on now and have been working on, looking to try to close before the end of the year due to the potential increase in the capital gains rate. That seems to have gotten a lot of business owners' attention of late, and you know, depending on how the Senate goes, that may be off the table at least for another couple of years. We'll see, but we have in the last month or so started to hear more about companies looking to close before the end of the year, just given that uncertainty.
And Dave, I mean, that's probably music to your ears, as there are more people looking to do M&A deals. That's always good for lenders. Are you seeing the same sorts of things?
Oh yeah, I mean, because these sellers are very smart guys. They realize what's going to happen. So, but oftentimes just these guys are 61 years old or 62 years old, and they want to take some chips off the table, and they may not want to sell the whole thing, but they understand what's going to happen with the new legislation. So, and frankly, it would happen anyway. I mean, once these guys, I mean, they have all their money tied up in this company, and they need to take some chips off and put them in the bank. Yeah. Thankfully.
Yeah, that's certainly a good way to diversify. Are you getting a sense that the elections impacted any of that, or do you think, you know, potentially you may see a big swing at the end of, you know, this year in December?
No, we always worried about, oh, this is going to happen right away, but it never really seems to happen like a big, you know, tidal wave. But I think, sellers, or for whatever reason, if they want to sell, they do it, or they may sell to a larger company. But this business is, everyone on his phone is a fantastic place, because every day some guy needs to have an accounting firm come in and look at due diligence, and then find the senior and the mezz or whatever. So it's a great industry, thankfully.
Yeah, no, it does seem that we've all been fortunate that the M&A markets have been much better than people expected. You know, back in the dog days of April, I'd say. And so there does seem to be a lot of signs that things are going to continue in a positive direction. Knock on wood for everybody on the panel and attending today. I do want to talk about how, let's say that it turns out that the Democrats do win the White House and Joe Biden's our next president. You know, that will certainly impact some industries more than others. There's been some, you know, concerns on the healthcare side that, you know, there's going to be, you know, some disruption either way, and potentially if you're in businesses that are working with Medicare and Medicaid, that could be a good thing. There may be some expansions to those programs. If you're in businesses that are relying or working with the federal government and heavy defense industries or contracting businesses, there may be, it's been a great time these last few years working with the government, and I think the Trump administration's been positive for the defense industry. That may change, and we've also seen, you know, some issues with China. We've got some clients that are in the heavy manufacturing space that have seen some disruption, and maybe a second Trump term would be less stable than a Biden term as relates to tariffs and things like that. So certainly every industry has the opportunity to be impacted by a change in the administration. What are you folks hearing? What are you seeing? What are you expecting that may be either good or bad for certain industries after this?
Well, I can start if you'd like. You know, this pandemic actually has certainly shifted the battlefield, the M&A battlefield over the past, you know, several months. And there are some areas, and some companies have done extremely well. Some have not. There now is the added factor about a new administration coming in, but we've seen some very interesting stuff. So we have recently done a lot of consumer products work. And it's interesting that a lot of the consumer products have wholesale and retail customers, and those that were geared up for online sales and really had, you know, good artwork and good product descriptions and pricing and easy way for people to buy from them online. The retail side of their businesses, by and large, in the several that we've done and have in process, have done quite well. The wholesale side of the business is down because that generally ends up at retail brick and mortar shopping places of commerce for customers. But I would say by and large in every transaction we've worked in now, consumer products, their e-commerce side has picked up dramatically. Some of that on the backs of Shopify and Amazon and others. But certainly it's more than offset wholesale as well. And then, you know, time will tell on other industries. Be interesting to see what my panel colleagues have to say about some of the other industries like defense and that type of thing.
Just to follow up on that, Rich, on the consumer side, we're seeing not only in consumer, but also in transportation and logistics, pretty much anything that supports e-commerce is doing well. And I think the question there is whether, and e-commerce obviously has grown as a percentage of retail sales pretty much steadily for the past decade. I think the question becomes, okay, when we hopefully get a vaccine and we can get back to normal or closer to normal, does that shift back to brick and mortar? Our view is that, yeah, brick and mortar will jump for some period of time, short period of time, but that the trend toward e-commerce is going to just inexorably continue marching forward in the longer term. So we're pretty bullish on that space, and the platform that we actually just formed in June of this year was in the consumer brand, small niche consumer brand, e-commerce focused area.
I think the more people get used to not having brick and mortar, the more people will get used to it quicker. So I think that's a good trend. You know, it's funny, the industry that we've seen really grow before the pandemic was the cannabis industry. And now a handful of states on Tuesday paved the way for recreational and medical usage in those states. So, you know, there was a big consolidation before, and I would expect there to be more consolidation afterwards. There's still a big hurdle, and that is for federal purposes, it's still a controlled substance. So the traditional tax rules that apply to regular companies don't apply to cannabis companies with respect to the deductions that they're allowed to take. So the effective tax rate for cannabis companies is extremely high. I don't know if a Democratic administration will address that or not, but that's something that remains to be seen.
And Dave, I mean, as a lender, you have a little bit of a different risk profile than the rest of us on this panel. Are there industries that you think you may be a little more careful, working with in 2021 if there's a change in administration, or conversely, industries you're more interested in?
Well, our business is, as I said before, it's tied to the owner saying, "I'm done with this thing." So now we had to, so they need some money out of it. But I mean, for example, we have some stuff in defense industries that people say, "Oh, we hate defense," and I say, "Except, well, we need some of these products that are." For example, one of these companies started doing World War II stuff for and they're still in the business, and the defense industry is not going to go away regardless of who's going to be in charge. And then, so the defense industry seems it could, for the really big super stuff, may get scaled back, but little things like machine gun armaments, that they need those all over the place. But as far as industrial products, those are little niche businesses that have high margins where the owner needs to sell. And so we see a whole bunch of those. We've done 3 of those this year already.
That's great.
We love it when sellers get old. We like that.
Happens to the best of them.
Yeah, shocking.
That's good. And so I know, Andrew heads the tax group at Marcum, and I want to, let you speak a little bit as to what we should be keeping an eye on over the next couple of months as to the potential legislation changes there may be, whether we're talking about capital gains, increase in corporate taxes, potential attacks on carried interest. What should people who are attending this webinar keep in mind or be looking about? And as we know, the Senate still up in the air. Certainly there'd be more likely for change if the Democrats are able to get 50 seats and win the White House and therefore control the Senate. What should we be thinking about, and what are people telling you?
Yeah, Chase. So it's really interesting. So I think before we get into the M&A market, I think it's important that we just understand kind of an overview of the Biden tax plan. His whole premise was to raise about $3.3 trillion over the next 10 years. And to do that, he would enact a number of policies that would raise taxes on individuals with income over $400,000 and also increase corporate tax rates as well. And so, with respect to the corporate side, that he's proposing to raise the corporate tax rate from 21% to 28%. Interestingly, Obama back in 2012 tried to push a tax plan through, and his tax plan was actually going to decrease the corporate tax rate from 35% to 28%. So I think Biden's looking to get that tax rate back to 28%. So that's going to obviously affect the way people look at corporations and putting themselves in a corporate structure rather than a pass-through structure. But let's talk about pass-throughs for a minute, because pass-throughs were afforded an opportunity of a 20% deduction called the Qualified Business Income Deduction, or the QBI deduction. Biden's plan also looks to phase out the QBI deductions for taxpayers with income over $400,000. So that's a direct flow through to the individual, and that determination is made at the individual level. In addition to that, Biden's looking to raise the individual in tax rate from 37%, which was just enacted in the Tax Cuts and Jobs Act in 2017, 2018, back up to the 39.6 where it was, again, for high income earners, which is defined as those with taxable income above 400,000. Perhaps the most significant of these of Biden's tax plan is to treat long-term capital gains and qualified dividends and tax that income under the ordinary income rate for those making above $1 million. And so that's really the crux of it. And then with respect to the carried interest, there's also a proposal by Biden to tax that at ordinary income rates, but he doesn't really need that, because this proposal to tax long-term capital gains at ordinary income rate really does that job for him. So he doesn't really need to address the carried interest rates at on its own, which is very controversial and has been for a number of years now. And it's made private equity folks, Gerry, and you could probably speak to this a little bit, a bit uneasy with respect to that. But he could accomplish taxing that carried interest at an ordinary rate without specifically calling it out. And so that's really on the table. And we talked earlier about getting deals closed by the end of the year to try to get into the tax rate, and the Democrats would have flipped the Senate, that would have been a real concern. But I would have to take all of that I just discussed, and I would kind of filter it out a little bit, because what's going to end up most likely happening is that there's going to be some watered down version of Biden's tax plan so that it can get through a Republican Senate. So I think will there be some change? Yes, probably. When the Tax Cuts and Jobs Act was negotiated, everyone thought that the corporate tax rate would be at 28%. They didn't think that it would go down as low as 21%. So there's a little wiggle room for negotiation before negotiations even get started. So Gerry, I would be interested to hear from you actually as to whether or not you're looking to sell your portfolio companies with respect to the proposed carried interest provisions that Biden has proposed to try to get out that carried interest before a potential tax law change. And just one more thing before I hear your comments. Now, Congress has the ability to make these changes retroactive. So as we get into 2021, if Biden claims the White House, then Congress could act all the way up to the end of December of next year and make it retroactive to 2020. Would they do that? That's unknown, but can they do that? And have they done that before? Absolutely, yes.
Interesting that you mentioned that, Andrew. We actually had one of our advisors go back and look at prior tax bills and look at whether they were prospective or retroactive, and the vast majority are prospective. I think the last one that was a tax increase, some of the tax reductions are retroactive, but the last tax increase that was retroactive was, I think, the Clinton Act of 1993, where they did do a retroactive tax increase. And so that's, from our perspective, we don't operate like a traditional 2 and 20 fund, so we don't have the carried interest rule. We do have the issue of capital gains being taxed at ordinary income rates, like any business seller would if that proposal were to go forward and to pass. It's not really affecting our decision making. I guess at the margin it does a little bit. If we had an opportunity to exit a particular portfolio company in the next 2 months versus the first quarter of 2021, if we can reduce the risk a little bit, then of a major tax hit, then we would do that. But we try to not let the tax tail wag the dog, if that makes sense. But we are seeing, from a buy side, we are seeing sellers that are trying to do that. And, some sellers have even asked us, and we've inquired with our own providers, whether there's like an insurance product that you can purchase to protect against capital gains tax increase, which I thought was interesting. I haven't gotten any positive feedback yet from our insurance providers, but the question's still outstanding. But that's how we view it from selling our existing portfolio companies. Not really looking at it that way, but from a buy side, we do see some sellers trying to get it in under the wire before December 31st, just in case there is a cap gains tax increase, and it is by chance retroactive.
Yeah, I read a figure while I was preparing for this that said, the traditional 20% would have to rise to 26% in order for private equity firms to take home the same amount as they would in a higher tax rate environment. And it's interesting on the insurance product. The insurance companies are coming out with some really interesting things. I had not heard the rate arbitrage product, but I know they've come out with things on the PPP loan, and because the SBA is auditing whether companies should have gotten PPP loans to begin with. and insurance companies aren't underwriting those policies as well. You can insure just about anything, I suppose.
Yeah, exactly. We've seen those, the PPP loan insurance. We've seen that. I'm not sure whether it's even possible to do the tax rate change insurance, but we've asked and are still awaiting an answer.
Right.
And I think, I mean, certainly the QBI, you know, phasing that out would impact a lot of sellers and would be a material change. And absolutely the capital gains, if that rate does, you know, spike up, that would impact valuations for sure. And it would, you know, there may not be time to get a new deal closed in 2020, but I think that would be a big jolt to the market, probably in a negative way, but you never know. I guess I'd also just ask, you know, Rich and Dave, do you think valuations would be impacted if there are these tax changes, or, you know, what else are you hearing from you know, your clients and your you know, the people you're partnering with on transactions?
Sure. Well, you know, our observations have been so far this year that valuations on a blended basis are actually up. We, of the deals that stopped in process that we were working on during March and then resumed, the valuations held, even though companies had been either adversely or positively, you know, impacted by COVID, right? And so there's the factor of, you know, taxes and structure and that type of thing. But Andrew's point is well taken, that as long as we don't have a Democratic Senate, then it's going to be hard for a tax bill to be pushed through Congress that, you know, is going to have maybe drastic effects for one group and not so much for another. And so we would expect it to be watered down to some extent. However, there are macro factors in the market that have been working for 10 years. And we think, irrespective of any administration, that it's going to continue. And one of those Dave alluded to earlier is that, you know, the demographics of the United States are aging, and a lot of mid-market companies are held privately by families who can't pass the management of these companies down to relatives who either aren't there or don't want to do it. And there maybe aren't some successors, or maybe there are, but the successors in the business also want to cash out. And so there's a tremendous amount of wealth that almost everybody is predicting, wealth in the form of ownership of private mid-market companies, that's going to continue along the lines of the demographic. And we've certainly been observing that for a while, and our practice has been robust for a long time. And as Dave said, and everybody that wants to, for every seller, there's always going to be a buyer. And so we think there are certain macro things that actually transcend what goes on in the market. The other big one is there was a shift quite a while ago, and we tracked it from about 2000 onward, that private equity owned private firms have increased about 5-fold through 18. I haven't seen, you know, the 19 numbers. And that's the reason for that is a lot of the money, the investors' money and institutional money, is trying to move away or has diversified their investments beyond the public markets because they've been so volatile. And quite frankly, the markets are more volatile than ever right now. So we think that's another factor that's going to continue to benefit, you know, the M&A market in a long term that may transcend some of these, you know, these more immediate, you know, issues with new administration and that type of thing.
And you've also seen a rise in the independent sponsors of the world, and I know we have some in attendance today. And so absolutely, as there's more capital that, you know, available, more independent sponsors, that's also helped transfer some of these private companies.
That's true, yes.
I want to just remind everyone again, any questions you have, please submit them, happy to discuss. We've got about 15 minutes left for this group. And I think, you know, one other question I do want to get to is, you know, we're all Andrew's right that if the Senate doesn't change, that does certainly mitigate a lot of the questions, or at least mute the impact of some of the potential tax changes. One thing that may still happen is another set of PPP loans. I think there is some potential bipartisan support for that, and it seems like Trump would be more, or I should say Trump be a little less likely potentially than Biden to have another round of PPP loans. So let's say there is the opportunity for Congress and the president to have another set of PPP loans. I guess, what do you think, one, is that necessary? Two, who would that be helping? And is that going to be a good thing for the market, a bad thing? I mean, how have you seen PPP loans impact your M&A world? I can say, personally, we've worked with a number of companies who did apply for and obtain PPP loans, and they were extremely helpful during that time period. I've also worked on now 6 M&A deals where the target company had taken out a PPP loan, and there are a number of issues involved with change of control with respect to a target that's taken out a PPP loan, and it's created a new source of, I guess, creativity as to how you deal with that. And we've seen a number of different responses, from forcing the sellers to pay it back, escrowing the money, applying for forgiveness quickly. And so what are you seeing in the market in terms of PPP loans, and whether or not there might be a supplemental stage of PPP loans in the next couple of months?
I followed PPP loans really, really closely through the CARES Act, along with the other tax provisions in the CARES Act. And everyone was really excited. And then the government started to make borrowers nervous because they imposed this, do you really need the money? And so that left out private equity, and it left out public companies. People didn't want to go to jail. And so, and then so it seems that the program was meant to help privately owned, mid-sized, and smaller companies. And that's an indirect way to answer your question, Chase, to say I would think, except for perhaps some industry bailouts that might need to take place, especially in the transportation and leisure industries. Again, I do believe that they would be geared towards smaller companies to keep Main Street employed. And I also think it's not just limited to PPP loans. I think, we've been waiting for a third round of stimulus or relief, call it what you may. But it's been, it was supposed to happen, back in early October. And now here we are post-election. And I think the answer to that question depends on who's going to win the election. If there's a lame duck session, there might be something to take place, or there might be nothing, and he just might, Trump just might, call it in and wait to leave it to Biden and have it be his problem. So
I would add to what Andrew said is post the CARES Act coming out, we've had numerous clients close that have PPP loans. And prior to the guidance that was issued last month, which was a few weeks ago because we're early into November, our clients were doing one of 3 things. They were either ignoring the rule that if there's a change in ownership, you must get a consent from the SBA. And they either ignored it and closed and said, we'll deal with this afterwards, or they were delaying their close and waiting until they filed for forgiveness, at least to that point. And so they at least had the ability to apply, even though the SBA and many of the banks were not taking applications. And then thirdly, there were a number of clients that were closing and escrowing the amounts for the PPP loans. Last month, the government came out and said, with a procedural rule that essentially got a number, the requirement is provided more guidance on how to close a deal when there's a PPP loan out. And essentially what it says is you still need to get consent from the SBA. It's still not entirely clear how quickly and how fast you can get it. But there's been a requirement in there, and it's been implemented by a number of banks and closings that we've seen, where the PPP loan plus 1 or 2% of the loan balance outstanding is escrowed. And then presumably the SBA will come out with more guidance on, on how it's actually going to work as opposed to the procedure for what you should do. And that's what's been happening in reality in the market. And I would say upwards of 80%, 85% of the deals that we've worked on that have closed had this issue that they had to deal with. So.
And of course, the SBA does not have a lot of employees. And when they do show up, they come in late and leave early because they're government people. So they don't really care. So it always takes you a long time to get simple things done.
Right. And the SBA, I mean, they told people you needed to get consent. And folks that were doing deals said, fine, how do I do that? What's the process? Well, they came out with the procedure on how to close a deal now, but it's still not entirely clear. I'm aware of at least one SBA region in the United States where a major bank who was the lender actually was given provisional authority to go ahead and grant the consent on a certain basis. And the basis was escrow, the loan amounts. And so it was delegated to that bank. They came out and put it in writing that the bank, this regional SBA is delegating the authority for us to do this. They weren't sure, and we're not sure if that delegation process is being enacted across the US. And we just viewed it as that, the SBA still doesn't have an internal process for approving or providing consent. So they're trying to get some help from the banks while they figure this out. I mean, that's our view, and we'll see where it goes. So.
Yeah, we've seen the same thing, and it's difficult, given the speed at which buyers and sellers want to move, to be waiting on the SBA is not always a great option. And so there's certainly been some frustration in terms of the timing. And I think most people expected the forgiveness would be resolved soon, but for many of our clients, they're still, they think they may not even hear by the end of this year on the forgiveness piece. So it's been moving a lot slower than people expected.
Well, the issue there is that the government said that a borrower has up to 10 months to file their application for forgiveness. And given that there are still many provisions of PPP loans that are unclear, like how much of the non-payroll expenses can you deduct and categorically and things like that, many of our clients are actually delaying their application. They have up to 10 months. Then once the bank gets it, the bank has up to, I think, 60 days to get through it and respond to the borrower and turn it over to the SBA. Then I think the SBA has another 90 days after that. So the questions we're getting is, are we going to have money in escrow on these loans for 2 years, for a year and a half and 2 years? And that's what the problem is right now.
Yeah, it is a bit of a cluster, quite honestly.
Well put.
And we're trying to deal with it through the escrow process. We're on the buy side. We're trying to deal with it through the escrow process because I'm not sure anybody knows exactly how it's gonna come out, given that the government's involved. But that's how we're trying to address it, which is one of the three options you mentioned, Rich.
I mean, Gerry, the companies you're looking at, how many of them? I know you're looking at a lot of smaller privately owned businesses. Are you seeing a lot of these companies that have taken out PPP loans, and is this a significant part of the negotiation, even maybe at the LOI stage?
Yes, a lot of them have taken out PPP loans. I wouldn't say it's a significant part of the negotiation. I mean, it's part of the negotiation, but I wouldn't say it's at the top of the list. It's material. It's I would call it in the middle list. It is a material issue. And I think in part because nobody's quite sure how it's going to work, and because it is an elongated time period, and because the guidance does seem to change every so often. So
And it's new.
it's an
There's not
issue,
a
but I wouldn't-
market as to how people typically deal with it, right?
What's that?
I said, it's also new, right? So there's
Yes.
not, you can say, here's what's market, here's what we've done in the
Right.
last 10 deals.
Exactly. And it's not only new, but it has changed over the course of the last 9 months, 8, 9 months, whatever it's been. So I think it adds a little bit. It certainly is an important issue, but I wouldn't put it at the top of the list compared to, say, acquisition price and structure.
Sure. Yeah, and I think escrow is becoming the most common response. I know earlier on, we were seeing a number of companies refund and basically just give the money back, or at least contemplate it. Seems now like more people are trying to escrow it. Sellers are, and it gets back to, I think what Rich was saying before, that valuations are still high. Sellers still have some leverage, a lot of leverage actually. And so the buyers are willing to accommodate. And, escrowing isn't always foolproof or easy, but it does seem to be, we're seeing the market move on, at least so far.
I think the issue of paying the loans back, though, is for our clients has been a little bit different, and that's again with a very thick coat of fog from the SBA. They said you shouldn't apply for the funds unless you need them, and so then that puts you in a predicament of two things. One is, did we get a consent? And when you get a consent, is the issue of whether we needed the funds or not going to come up? And is there some other liability that someone's going to have to deal with outside of forgiveness of the loan? Was the company entitled to the funds? And the government came out and said they're going to guaranteed audit everybody that has a loan that's over $2 million. But the whole guidance on whether you needed a loan or not, I mean, you had a number of companies who said, yes, we have cash in the bank, we can cover our expenses for the next 5 months, but then after that, we'll go bankrupt. So yes, we need the funds, and money is fungible. And we've done, a longer term projection, and we can show we need the funds in that context. And so again, not many believe that the SBA is fully equipped to understand this. And it's an issue that's starting to rear its head, hopefully not too much in an ugly manner, as applications now are starting to go in on loans that are greater than 2 million. So it's just another wrinkle of, free money really has its strings when it comes from the government.
We did have one question from the audience. I think, Rich, it's directed your way. You had asked, or I made the comment earlier, that valuations have held. And I think that we probably all agree with you on that, despite what the fears were about COVID, valuations have held. Question is that because of certain COVID related adjustments, or because the underlying businesses have performed as expected? And to the extent you have seen COVID adjustments, and I guess the question is probably asking, are buyers basically giving a pass on a dip in EBITDA? What are you seeing there?
It's actually an excellent question. And the valuations seem to be impacted most when there are some fundamental things in the economy that aren't working very well, right? And that hasn't been the case with COVID. It's a pandemic that no one has ever had to deal with before. And so most of our clients, buy-side clients, have looked at these companies and said, are they fundamentally sound still? Are they going to be able to pull out of this in the same manner or better than everybody else? Now, we've had at least 2 deals, one a servicer in the airline industry, a service provider in the airline industry, and another in the travel industry, whose deals have stopped and they haven't reignited.
Tougher cases.
Yeah, so the deals that are closing are the ones that are doing well or good enough, and they don't have fundamental issues with their, with their markets, even though they have been impacted by COVID. At least this is what we're seeing. And there are deals that are, on the bench right now, waiting to see how much more government aid is going to come, how much more, and we have a number of restaurant clients, big restaurant groups. And so those are all uncertain, and those deals aren't closing. So it's hard to see what happened to their valuations. One could say their valuations have gone to nil until the uncertainty is lifted. But for the deals that are closing, they're closing, at pretty healthy multiples, actually more than healthy, probably expensive multiples. It's been a seller's market for the past 5 years. So.
Absolutely.
Interesting that you mentioned that, Rich. We are seeing, the businesses that have performed through this, we see multiples as high as they were in January, February. Obviously, a lot of companies have been affected, and it's trying to figure out, okay, how much of the business was lost temporarily versus longer term is an issue to try to figure out. But we've seen some interesting approaches as far as pro forma for COVID. We actually saw one company that tried to add its PPP loan into its EBITDA. It actually counted its PPP loan as EBITDA. So I thought that was the most creative that I'd seen. But it is, we are seeing a lot of pro forma adjustments for COVID.
Well, I want to thank everybody once again for joining. I do see it's now 12:30 here in New York. So really great discussion. And Dave, Andrew, Gerry, and Rich, really appreciate the time. And thanks to the audience as well for participating. Lena, I know we've run out of time. Or anything else we should add?
Yeah, no, I just want to thank you all again. Thank you, Chase, for leading the way, and to our panelists for your contributions, to our audience, of course, for joining us, and to our sponsors for your continued support. For those of you who are participating in our Deal Connect, you're going to want to log out of this link now and log into the separate link that my colleague Terrence Winters circulated yesterday. We do have another panel coming up November 19th, LP investing in this market. So stay tuned for more information on that. We have another one in December coming up, and many more after that. So stay tuned. Again, if you're participating in Deal Connect, please log out of here now and log into the separate link. We hope to see you all soon, hopefully in person. We don't know when that's going to be, but until then, stay safe, stay healthy, and we look forward to seeing you all soon.
Thank you.
Thank you.